How to read the most popular crypto candlestick patterns. What are candlesticks? Candlesticks are a type of charting technique used to describe the price movements of an asset. First developed in 18th century Japan, they've been used to find patterns that may indicate where asset prices have headed for centuries. Today, cryptocurrency traders use candlesticks to analyze historical price data and predict future price movements. Individual candlesticks form candlestick patterns that can indicate whether prices are likely to rise, fall, or remain unchanged. This provides insight into market sentiment and potential trading opportunities. What is a candlestick chart? Imagine you are tracking the price of an asset like a stock or a cryptocurrency over a period of time, such as a week, a day, or an hour. A candlestick chart is a way to represent this price data visually. The candlestick has a body in two lines, often referred to as wicks or shadows. The body of the candlestick represents the range between the opening and closing prices within that period, while the wicks or shadows represent the highest and lowest prices reached during that period. A green body indicates that the price has increased during this period. On the other hand, a red body indicates a bearish candlestick, suggesting that the price decreased during that period. How to read candlestick patterns. Candlestick patterns are formed by arranging multiple candles in a specific sequence. There are numerous candlestick patterns, each with its interpretation. While some candlestick patterns provide insight into the balance between buyers and sellers, others may indicate a reversal, continuation, or indecision. It's important to note that candlestick patterns aren't intrinsically buy or sell signals. Instead, they are a way of looking at current market trends to potentially identify upcoming opportunities. As such, it's always helpful to look at patterns in context. This can be the context of the broader market environment or technical pattern on the chart, including the Wyckoff method, the Elliott wave theory, and the Dow theory. It can also include technical analysis, TA, indicators such as trend lines, the relative strength index, RSI, stochastic RSI, Ichimoku clouds, or the parabolic SAR. Candlestick patterns can also be used in conjunction with support and resistance levels. Support levels are price levels where demand is expected to be strong, while resistance levels are price levels where supply is expected to be strong. Bullish candlestick patterns. 1. Hammer. A hammer is a candlestick with a long lower wick at the bottom of a downtrend, where the lower wick is at least twice the size of the body. A hammer shows that despite high selling pressure, bulls pushed the price back up near the open. A hammer can either be red or green, but green hammers may indicate a stronger bullish reaction. Inverted hammer. This pattern is just like a hammer but with a long wick above the body instead of below. Similar to a hammer, the upper wick should be at least twice the size of the body. An inverted hammer occurs at the bottom of a downtrend and may indicate a potential to the upside. The upper wick indicates that the price has stopped its continued downward movement, even though the sellers eventually managed to drive it down near the open. As such, the inverted hammer could indicate that buyers may soon take control of the market. Continuation candlestick pattern rising 3 methods. Falling 3 methods. The inverse of the 3 rising methods, the 3 falling methods instead indicate the continuation of a downtrend. Continuation candlestick pattern, falling 3 methods. Doji. A doji forms when the open and close are the same or very close. The price may move above and below the open but will eventually close at or near the open. As such, a doji can indicate a point of indecision between buying and selling forces. However, the interpretation of a doji is highly contextual. Depending on where the open and close line falls, a doji can be described as the following. Gravestone doji. This is a bearish reversal candlestick with a long upper wick and the open and close near the low. Doji candlestick pattern, gravestone doji. Long-legged doji. Indecisive candlestick with top and bottom wicks and the open and close near the midpoint. Doji candlestick pattern, long-legged doji. Dragonfly doji. Either a bullish or bearish candlestick, depending on the context, with a long lower wick and the open/close near the high. Doji candlestick pattern, dragonfly doji. According to the original definition of the doji, the open and close should be the same. What if the open and close aren't the same but are very close to each other? That's called a spinning top. However, since cryptocurrency markets can be very volatile, an exact doji is rare. As such, the spinning top is often used interchangeably with the term doji. How to use candlestick patterns in crypto trading. Traders should keep the following tips in mind to use candlestick patterns effectively while trading cryptocurrencies. 1. Understand the basics. Crypto traders should have a solid understanding of the basics of candlestick patterns before using them to make trading decisions. This includes understanding how to read candlestick charts and the various patterns that can form. 2. Combine various indicators. While candlestick patterns can provide valuable insights, they should be used with other technical indicators to form more well-rounded projections. Some examples of indicators that can be used in combination with candlestick patterns include moving averages, RSI, and MACD. 3. Use multiple timeframes. Crypto traders should analyze candlestick patterns across multiple timeframes to gain a broader understanding of market sentiment. For example, if a trader is analyzing a daily chart, they should also look at the hourly and 15-minute charts to see how the patterns play out in different time frames. 4. Practice risk management. Using candlestick patterns carries risks like any trading strategy. Traders should always practice risk management techniques, such as setting stop-loss orders, to protect their capital. It's also important to avoid overtrading and only enter trades with a favorable risk-reward ratio. Closing thoughts. Every trader can benefit from being familiar with candlesticks and what their patterns indicate, even if they don't incorporate them into their trading strategy. While they can be useful in analyzing the markets, it's important to remember that they aren't infallible. They're helpful indicators that convey the buying and selling forces that ultimately drive the markets.